Hi, everybody. I'm going to get started. Thank you so much for attending and coming and listening to this talk. It's called Can You Get Value from Cryptocurrency Without Giving Up Control? I'm going to talk about financial services. My company, On-Chain Capital, provides financial services, in particular lending. But is it possible in general for cryptocurrency investors to gain the benefits of services like lending without having to give up control over their assets? Remember, that's one of the coolest and most unique aspects of owning cryptocurrency, is that you really are sovereign over your own wealth. Is it possible to get additional services and additional value without giving up that sovereignty? Before I get into kind of the details of this question, I want to talk a little bit about motivation. This is a chart from an article that my company published earlier this year. If you search for HODL, H-O-D-L, HODL waves, you'll no doubt find our blog post. And what is this chart trying to show? Let me take a minute and just try to describe it. It's a chart on the x-axis. The horizontal bottom axis is time. We're starting out at the beginning of Bitcoin's history, 2009. And this chart runs all the way to about 2018, the early part of the year. I'll show you an updated version of this in just a second. What is the chart trying to show? Now, remember, over this full time period, this is like 10 years or so, during this time period, Bitcoin's absolute money supply has grown by a huge number. It started out with 0 coins back in January 2009. There's some 17 or 18 million coins out there today. So what we've done is at each vertical time slice, we've normalized by the number of Bitcoins in existence at that time. So we've just divided by the money supply. And the colors, what do the colors mean? At each vertical time slice, we are splitting up the money supply that existed at that time and coloring Bitcoin by the age at which they were last used, not the age that they were mined at. That's a pretty straightforward distribution. Most Bitcoin were mined very early and less over time. We're talking about the age that they were last transacted in, spent, transferred, as evidenced by transactions on the blockchain. Remember, Bitcoin lets you look at its full history. These are really UTXOs for those who are in the know about this. It's one of the only asset classes, blockchains, that let you do these sorts of post hoc detailed analyses. It's pretty remarkable. So this chart kind of tries to show that in the red colors, we've got very young Bitcoin, or Bitcoin that was very recently used. And in the cooler, greener, and bluer colors, we've got Bitcoin that's extremely old, hasn't been used in up to 5 years for that bluish category. Now, over the 10 years or so that this chart spans, you can see that there are these waves. We've sort of tried to trace the crests of those waves there in those white lines, and we've given them kind of cutesy little names. What do those waves represent? They represent accumulation between rallies in Bitcoin's price. That black line, it's logarithmically showing the price of Bitcoin over the same period. And you can kind of see as the price starts to cross various thresholds determined by people's expectations and prior histories, there's these waves of accumulation that we call HODL waves that kind of break. So if you're interested in the implications of this analysis, Google this, come check it out on the blog. But we made this chart first in 2016. Now, we launched our company the following year to give loans to people who have Bitcoin and Ethereum as collateral. Why did we do that? Because when we made this chart in 2016, what was it telling us? If you kind of look at the 2016 and you kind of trace vertically upward, you see there's a lot of green and blue in that era. That implied that a large amount of Bitcoin's money supply in 2016 was extremely old by this definition. Now, the total market cap of Bitcoin in 2016 was much smaller than it is today. It was maybe $10 billion. So in aggregate, we're talking about a much smaller amount of coin, but a lot of it was still old. Enough we felt that there was an opportunity in trying to consider, well, who are these people that are just sitting around with Bitcoin and what can we do for them? In particular, here's an updated version of the chart. I'll also just note briefly that this is literally current, I think, as of today, that yellow, you can see that yellow wave kind of establishing itself again, right? That's coins that's 6 to 12 months old, right? Those are people who acquired in this last rally, right? They're becoming the dominant cohort of Bitcoin ownership, and that will soon become coins that are 12 to 18 months and at some point forward. But eventually, if another rally occurs, this wave of accumulation should break. Right, and we'll have another off sell. And so that's just an interesting thing to see that self-similarity in Bitcoin's history as it develops. But looking at this chart in 2016, when my co-founder Joe and I made it, it was clear to us that there were different kind of cohorts that you could segment Bitcoin and therefore Bitcoin owners into. The first is kind of at the top here. These are the coins that are the oldest, right? These coins are almost certainly lost, or they belong to Satoshi, whoever that is. I'm willing to say that these coins are out of the picture for now. They may as well not exist in the world. There's another category. These are fast-moving coins. Those reds and bright yellows and oranges, those are coins that are 1 day old, 1 week old, less than a month old, or used most recently within a day, a week, or a month. That's exchanges, that's people with hot wallets, those are traders, people making actual payments on Bitcoin, and they have a lot of services. Bitcoin has a lot of saturation of vendors and providers in that space. There are too many exchanges and wallets already. It struck us that there's this middle ground. This is 2016 when we're first elucidating this to ourselves. There's this middle ground. It's whales, it's hodlers like ourselves, it's folks using cold storage, hardware wallets. This is actually the largest cohort of Bitcoin ownership. Yet there was nobody targeting these people and saying, what are the products that you need? You're clearly not trading every day, so you don't care about like lower exchange fees or like cool opportunities to make margin. What you care about is security, the long-term health and preservation of your cryptocurrency, the ability to get liquidity so you don't have to sell it, the ability to protect it with financial instruments as well as with physical and better operational security. You are a long-term holder, you believe. That's who these people are. So what did we decide to build for them? We decided to build a crypto-backed loan product. In our view, this was something that would help investors hold their Bitcoin through the winters, through times in their lives when they needed cash and were otherwise tempted to sell an asset that has appreciated at almost 500% per year, year on year, since its inception. That is a remarkable asset that one would not want to sell, and by offering investors the ability to defer that decision to a later date, we felt we were helping them preserve their wealth. So just a brief note on the terms here. There's a diagram, which I'll get to in a second, but how do our loans work? They work with Bitcoin and Ethereum. You give us collateral. If you want to borrow $100,000, you need to give us $200,000 in Bitcoin or Ethereum. So it's 50% loan to value ratio. Our interest rates, typically they hover between 10 and 12% APR, but in the next few months we are running a promotion. So if you're interested in borrowing, you can get rates as low as 5.99%. Payments are typically interest only, by the way, with a balloon payment due at the end of the term of the loan. Loan terms, our borrowers typically borrow between 3 months and 5 years. There are no prepayment penalties, so if you decide you need to exit your loan, you're absolutely free to do so. Just pay back the principal, and we can get you your money into your bank account within 24 hours for loans up to $1 million. Those are just the summaries. I'll talk a little bit more about how our product has performed and kind of the history that we've had with it, but look at this diagram. It tries to visualize the way that our product works. If you're a borrower, you talk to us, you escrow your funds into an address that we'll give you on the blockchain. We speak with lending capital providers, and we give you the money that you need. But let's dig into this section over here. Let's really dig into what it means for borrowers to give us their cryptocurrency. As a lending provider, we have certain guarantees that we're on the hook for to our own capital providers. They want to ensure that when we claim that we have taken some amount of Bitcoin or Ethereum as collateral, that we really can access it, that we can perfect that collateral, that we could sell it in the market if it came to that point. We can't allow our customers to control access to it. But by the same token, customers are extremely uncomfortable with the idea of just giving somebody else their cryptocurrency. As we talked about, can you access value like liquidity without having to lose control, right? That's a question a lot of our borrowers struggle with. So let me talk a little bit about what protecting collateral means to us. So when we started this business last year, we actually spoke at the Texas Bitcoin Conference right around this time last year. We were just getting started. We were literally lending our own money. Joe and I, who's actually in the audience, we're the co-founders of the company. We were lending our own money. We ran all our own Bitcoin and Ethereum through the system to verify that it worked. That is a terrifying experience. If you've never written code, you know that all code is fundamentally broken, your code most of all, and to trust your broken code with real money is terrifying. But of course, how can you ask customers or lending capital providers or borrowers or anyone else to do that if you're unwilling to do it yourself? So in doing it ourselves, it really upped the standard for what we felt we needed to provide in order for ourselves to feel comfortable. What did that look like? I organized this as a no and a yes, right? Things that are bad versus things that are good. We do not want account-based security. We do not want usernames, passwords, and 2FA codes to be what protects our cryptocurrency. We want actual cryptographic key-based security, private keys and public keys. Right away, this means exchanges are not an option for us. Exchanges don't offer you that level of access into your funds. You only are protected by traditional network security tools, which we don't want. Furthermore, we don't want single signature. If we are going to have keys, we want there to be more than one. One key is insufficient. 2 keys out of 3 in particular, we think provides the best and most optimal balance between redundancy, security, and complexity. So we like 2 out of 3 keys, multi-sig. Most blockchains will provide that either built in or something that you have to create yourself on top of it, as in Ethereum. We also don't like hot wallets. If you are an exchange and you have millions of users that are transacting constantly and expect to be able to get in and out of their positions very quickly, you're going to need a hot wallet. If you are a financial services firm and you are giving a 5-year loan to someone and you're using their life savings as collateral, you should not use a hot wallet. You should use a cold wallet that you will not have to disturb for many months or years. That allows you to have better security. Commingling. Exchanges commingle funds. Everybody's funds are protected and merged together, and what distinguishes them is entries in a database. We found that very curious, given that blockchains are fundamentally accounting structures. Is it not possible to offer customers dedicated per customer, per loan addresses using deterministic wallets and various other sophisticated programming primitives? It is possible, and it should be done because it increases transparency. Lack of control. Has anybody ever had a conflict with a large exchange over your account? You feel powerless. You feel absolutely powerless. And that is not something we wanted to feel in regards to our customers' collateral. And going along with that, no support. It's very difficult, given the scale of many large exchanges, to get the support that you need to feel confident. And if you use a smaller exchange, you don't have as much confidence in their security models. So you're kind of a little bit, it's a trade-off that you can't really optimize very well. And great support is not just about making customers happy, it's about security, right? If customers feel like they can call you and talk to you, they're not going to accidentally input a wrong return address. You can confirm that return address with them. There's no need to rely upon automated systems if you have a lower volume, smaller number of customers and a more high-touch experience with excellent customer service. And so that's really the thesis of this slide is, look, if you really start from custody and you try to do custody the best way that you can, you will wind up with a system that is not only secure, but it is also transparent, and it also forces you to render really excellent service to your users. Cool. So I may be selling you that I know how to do this right and I've been doing it right, but you should still ask, if you're a suspicious and rightly so person, who holds these keys? Can I get the utility, the value of liquidity without having to lose control, right? There are multiple keys. Who owns those keys? So heretofore, our company for the past 15, 16 months has operated using what we call a single institution custody model. It's always been multiple signatures, always cold, always hardware or offline wallets, so extremely secure, but it is true that customers have had to surrender their control. They need to trust that we are a bona fide company, that we're not going to abscond with their funds. It's absurd, we never would, but they must trust that we wouldn't. Now, who has been willing to trust this? It turns out a lot of people. Right, we've been operating since about June 2017. We have more than 100 customers. We've given more than $10 million in loans. We are managing more than, I think 20. This has grown. A lot of people are willing to trust a solution like this because they're willing to give up control if they get enough value, if they get a loan, if they can borrow without having to sell their crypto. But can we do better? Right? When we started the company, we wanted to offer a more participatory or collaborative model. We did not launch with that because it's extremely difficult to engineer that safely, but we've had a year of building and we've built it. And this week, there'll be a more detailed press release, but we are releasing what we call a multi-institution, multi-signature custody model for the lending industry. This is the first of its kind. This is collaborative cold storage for individuals who want additional value, but who don't want to surrender control. In a model like this, it's still a loan. You cannot just spend all the collateral if you wish. That's not a power that you have. But by the same token, neither can we. We would only have 1 out of the 3 keys that is required to sign transactions from a quorum that were built like this. In order to liquidate your funds, we would need to cooperate with our third-party key agent who's tasked with protecting us. If we were to disappear, you as a borrower could summon that third-party key agent and work with them to recover your funds. These are not really options you have as easily if you have a single institution that's protecting collateral. So we're launching this next week. I'm very excited about it. I view this as a huge improvement in security and a reducement in the amount of trust that customers need to invest in us in order to access the value proposition of liquidity. So I'm very happy about that. But it's still the case that to work with us, customers need to borrow. You need to have a loan. You need to be willing to take on debt and service interest payments. And what we've been hearing from our existing customers is, we really like your product, your team is awesome, the service is great, I don't always need a loan. I'd like to access collaborative cold storage-based custody models. Like, I have a hardware wallet, I've got a Trezor, a Ledger, I want to be part of this, but I don't need a loan. So can you offer me a custody product? And it's something that we have now started to do. We're not selling this product today in the open market. We're using the same technology that we've always been using to drive our loan product, but we are looking for customers who want to deposit Bitcoin and Ethereum with us to try out a new vaulting structure. We will not be charging for it for about the next quarter. We're just looking for feedback. This is not a beta. This product has been running for more than a year already, protecting tens of millions of dollars in customer funds, but it is a new form of accessing that custodial structure without necessarily having to take a loan. It comes in two flavors. I'll just give you a taste of each. The first model that this could work with is what we call the countersigner model. If you have two keys and we have one key, one way you could arrange it is that one of your keys is kept holy and backed up, that you never use it. It's on paper. It's split up. It's far away. It's inaccessible but safe. And you have a second key, perhaps, that you've loaded into a hardware wallet or an offline wallet, a Trezor, a Ledger, and we have a key that you've trusted us to keep for you. In a model like this, every time you need to transact, you can initiate, author, and sign a transaction. We will countersign and broadcast, and there you go. But you're not losing control. If you don't trust us, if we disappear, you can go wherever you've stored that third key, and you can use it on your own in completely without our cooperation and recover your funds. Again, you can see why we couldn't use a model like this for a loan, where we have a principal obligation to our lending capital providers, but this does make a lot of sense for a vaulting and custody solution. There's another way you could do it. This is called, we call this the key recovery model. You could sign and countersign all your transactions, like maybe you and your business partner or you and your spouse are signing and countersigning every transaction, and now if either one of you loses your key, all we are is a backup. We're not even involved in your daily business. We're just providing you additional security. And again, since you hold 2 out of the 3 keys, you are free to transact without us. So this is finally, I can say truthfully, a situation in which you as a customer are getting a lot of value. You're getting someone to back you up. You're getting someone to help you out with forks, to help you with your hardware wallet. These are all the aspects of this product that come with it. You're getting someone to provide you with more security. If you are holding a significant sum of funds on a hardware wallet like a Trezor or Ledger, and you're doing it by yourself, you're subject to a host of attacks, right? The $5 wrench attack. I know there are people in this audience right now who have a hardware wallet that is worth more than their home. That's an absurd situation to be in. You should not be on your own, no matter how much of a badass, libertarian, Bitcoin-aware person you are. You should be sensitive to the idea that cooperation with people you have chosen to trust is not the same as giving away keys. It's a reasoned approach to actually providing yourself more security without losing control. And so that really finishes the talk out. If you're interested in learning more about Unchained Capital, our blog, our writing, our data science, come check us out. If you're looking for a loan, I can't stress that this is a great time to borrow. We are in the winter, right? This is a great time to borrow. Don't sell now if you're thinking about it. And if you are interested in participating in our vaulting product, to try this out, again, it's no charge right now. We just want feedback. We want people who have hardware wallets, who want the additional protection of having chosen collaborators in their quorums to work with us. So if you're interested, come reach out to myself. There's a few other folks in the audience from our company. Maybe they could raise their hands. They're sitting in that row over there. Come find us today or tomorrow during the conference and chat. We'd love to hear from you guys. So thanks for listening. How'd I do on time? Any questions? Okay, not too bad. Questions, anybody? Yeah, please, shout it out.
Is this on? Hello?
Yeah.
Yeah. So I'm curious as to what you think about this. So people who take out loans with you, most of them maybe need the cash or fast cash or something like that, but some of them presumably wanted to have their crypto be put to work for them, so get that and reinvest it. What do you think of staking coming up specifically with Ethereum? And some people may turn to that as an alternative. Are you guys preparing for that, or do you think that's going to eat into your business plan at all?
I think that's a great question, and you're absolutely right. Your intuition is correct. One of the chief reasons people borrow against their cryptocurrency is to turn an asset which appreciates on paper, so to speak, that its value goes up, but it doesn't provide any sort of income. There's no dividend. There's no fixed income that you can generate from holding this asset class. And if you're sitting on a lot of crypto, I mean, how many more years will you wait to sell, right? So you could realize your gains now, or you could try to put it to work, in your words. And that is the number one probably use case of our borrowers, is in particular making investments in real estate, and companies. I like the juxtaposition of using your funny digital money and leveraging it to go buy real physical things. That's an extremely interesting way to do it. And a lot of folks will, in particular, we have one customer that flips houses, right? They borrow against their Bitcoin, they borrow enough to buy a home, make a down payment, improve it, and then they just flip it and they're making a nice return. That's an extremely sophisticated investor that's organized, has the capital and the wherewithal to do something like that. Most investors don't. Most investors don't have the ability to take a situation where they're borrowing and then be clever and principled and safe and turn it into a reliable source of fixed income. And so the idea of being able to do it for them, of being able to take their assets and turning it via staking, or let's say via the Lightning Network, or one of any other number of schemes that are now starting to come online over the next couple of years, I think is extremely interesting. Now, our product you can kind of think as having started in the lending category, and now we're starting to extend ourselves into custody, but fixed income is also a really interesting category. Over time, I could very much see ourselves heading in that direction and allowing our customers to either borrow more cheaply or to just earn a return off of funds that are in their vault if they agree to let us use those and rehypothecate them in other ways. Today, we don't rehypothecate ever. Now, there are other companies that do that. In my view, they do it unsafely. They do it through leveraged day trading inside of various exchanges. I don't think that's a very defensible or safe way to treat people's life savings or their collateral. But things like staking or the Lightning Network may one day indeed be safe ways to do that. And so I think once they are and they're compatible with our standards for security, I'd very much like to expose those. Any other questions, guys?
I got one more for you.
Yes.
Just curious about the 50% number for the ratio for the loan. How do you justify that? Where'd that number come from? I noticed that your competitors are pretty similar in that aspect. So why is that the chosen ratio?
We did the calculations originally. I exited sharing here because I just want to open up another quick deck that I think has a really interesting chart. Hopefully I don't screw this up. Oh, there we go. Okay, let me show this chart, which I think is pretty interesting. This is a chart from a different presentation that was more geared towards our lending capital providers, and it kind of shows the historical volatility of Bitcoin over a significant time period, plotted in an interesting way that helps you kind of come up with exactly that figure of 50%. So taking a look at what this is trying to say is, let's say you borrowed on every single day historically over the course of, this is I think done for Bitcoin, yeah, Bitcoin over a 2 or 3 year period there at the top. If you borrowed every single day and you looked back some number of days later, 1 month, 3 months, 6, 9, a year later, what would be the relative change in your collateral? The value of your collateral, right? How would the price have changed? And you can kind of see we've statistically just added up every single possible combination of days and borrowing intervals. And what you tend to notice there is a significant volatility on the 1 to 3 month time scale, that there are significant, the colors here represent percentiles. So in the yellow, you're at the kind of the first standard deviation and so on. Standard deviation is not really the right word to use here because this is not necessarily a normal distribution, but in red, and in particular in that dashed red line, you see kind of the extent of all possible variation that's occurred historically. So the net of this graph, in my view, is over the 6 month time frame, it's almost always the case that if you have collateral or some supply of Bitcoin, 6 months later it will be worth more. In fact, it's almost never been the case that that's not been true. Now, it is true, though, that with some significant frequency, between 1 and 3 months, that if you borrow, it may go down in value over that time period. So part of this is how we wound up with our kind of 3 month initial loan terms, that we feel like that's a good window to pick because it kind of crosses that first regime of volatility. And then also 50%, looking at it historically, Bitcoin has almost never dropped below 50% in these time intervals. And so we think that gives us a good, and I believe the largest 1 day drop is something closer to 20-something% in Bitcoin. So those numbers are really what we started with and gave us a really nice kind of like backbone upon which to do it. Other companies copied it, I'm guessing. Yeah. Yeah, that green line is meant to be kind of your break-even point, and you can kind of see that the variation is really never below the green line after about 6 months. Now, again, the past is never a complete predictor of the future, and to your comment, like, yeah, there are definitely anywhere between 1 and about 6 months, there are days where you could have picked where 6 months later the price would have been lower, and January 1st might have been one of those days, right? But there aren't a lot of those days in the history of Bitcoin. That's kind of the argument that this chart is making. And I hope that answers your question. Any others? So we have great relationships with OTC desks today. We can liquidate a lot of crypto if we need to. We do liquidate customer loans occasionally, but typically because they ask us to. They say, okay, I want to pay off my loan. Can you go ahead and liquidate 30% of the collateral? I'll provide the rest in cash or something like that. So that's usually how we do our liquidations. Today, we have yet to ever have a customer completely default on us. That we survived January to March or April this year. That's a 70% drawback in price without a single default-driven liquidation. Now, that sounds remarkable, but you think about who our borrowers are. There are people who chose to borrow so they wouldn't have to sell their crypto. To have it be sold out from underneath them later on in a margin call is like the worst outcome, right? Not only are they forced to sell on that issue, but they're also now forced to pay taxes because they're going to have capital gains on what was sold. So they're extremely incentivized not to let that happen, and we're very proactive. We monitor these balances continuously. It's easy to do. It's all on the blockchain, and we give them warning. You get 2 days warning when prices cross below an acceptable threshold. You can correct that by providing more collateral or by adding more principal. During some of the worst weeks that we had in January, February, and March this year, we were margin calling like 90% of our loan book, and our average time, I always get this wrong, it's actually 80% of customers, I think, were able to respond and add more collateral within 8 hours. Like, that's an incredible rate of recollateralization. We had one customer who received a margin call, and we had a transaction not fully confirmed, but noticed on Bitcoin 7 minutes later. And so that's incredible to be able to recollateralize a position in 7 minutes, because cryptocurrency networks really do move that quickly. Any other questions, guys? Thank you so much for listening. I hope this has been interesting. And if you're excited about a loan or getting more secure, you have a hardware wallet, you want to be safer, come talk to us.